Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and today we're diving into Kratos Defense Security's 10K filing for fiscal year 2025, filed February 23rd, 2026. With me is Mike, our defense sector analyst. Mike, this is a company that straddles both aviation and defense. They're making unmanned aerial systems, hypersonic vehicles, and jet engines alongside traditional defense electronics.
That's right, Sarah. And if we reduce this filing to one sentence, it's this. Kratos is executing a massive capital expansion bet on a generational defense recapitalization cycle while absorbing significant margin compression from labor and supply chain inflation. Based on this filing, Kratos Defense and Security is operating in mid-cycle expansion. They're past the early recovery phase, but not yet at peak margins, with record backlog driving aggressive capacity investments.
Let's start with the material changes versus their prior filing. What jumped out at you in the numbers?
The revenue growth is substantial, up $210.5 million to $1.346 billion in fiscal 2025 versus $1.136 billion in fiscal 2024. That's an 18.5% increase, which for a defense contractor of this size is quite robust. But here's the concerning part. While revenues surged, gross margins compressed significantly from 25.3% to 22.9%. For context, defense contractors typically maintain gross margins in the 25% range, so Kratos is now at the lower end of that band.
What's driving that margin compression?
Management was explicit about this in the MD&A. They cite less favorable revenue mix and increased costs across the board. Specifically, they state that cost of revenues increased $189 million to $1.038 million, driven by what they call increased labor and material costs. The causality chain here is critical. If labor shortages and inflation persist, which management expects they will, margins could compress further, fundamentally changing the investment thesis from a growth story to a margin recovery play.
And this is hitting both segments?
Exactly. The KGS segment saw margins decline from 27.6% to 24.4%, while the US segment dropped from 17.9% to 17.4%. The KGS decline is particularly notable because that's typically their higher margin business. When your premium segment is under pressure, that suggests industry-wide cost inflation rather than company-specific execution issues.
Let's move to management commentary. What signals are you picking up from their tone?
Management is simultaneously bullish on demand and candid about operational challenges. They open with what they call record levels of backlog and opportunity pipeline, and describe a generational recapitalization of weapon systems and related defense industrial bases occurring globally. That's optimistic language suggesting a multi-year demand cycle.
But there's a flip side?
Absolutely. They're remarkably direct about cost pressures. Quote, inflation and the related increased costs of inputs needed to execute our business, including materials, parts, supplies, consultants, subcontractors, vendors, etc., have significantly increased our business costs and have adversely impacted our operations, profit margins, and financial forecasts. That's unusually blunt language for a defense contractor. They're essentially telling investors that their forecasting accuracy is compromised by cost volatility.
They also mention labor challenges specifically.
Yes, and this is where it gets concerning from an execution standpoint. Management states there's an industry-wide shortage of qualified labor, and that the challenge of retaining skilled, experienced production personnel has continued to negatively impact our operating margins, especially on our longer-term, firm, fixed-priced production contracts. This is a high-wire execution scenario with limited margin for error. They're locked into fixed-price contracts while input costs are rising unpredictably.
Speaking of execution risk, what financial red flags are you seeing?
From a balance sheet perspective, there are actually some confirmations rather than red flags. They're sitting on $560.6 million in cash and equivalents against $296.7 million in total debt. That's a net cash position of roughly $264 million, which provides significant cushion for their aggressive capital expansion program.
But they're burning through working capital?
Correct. Management explicitly states they've implemented advanced and larger lot purchases of certain materials and parts, which has resulted in an increased use of our working capital, which is expected to continue. The causality chain here is, if supply chain disruptions persist, working capital consumption accelerates, potentially offsetting their strong cash position within 12 to 18 months if not managed carefully.
What about the revenue quality? This is a defense contractor, so backlog matters.
The filing mentions record levels of backlog, but frustratingly, doesn't provide the specific dollar amount or book-to-bill ratio. For defense contractors, we typically want to see funded backlog numbers and conversion timelines. Without those metrics, we can't assess whether this revenue growth is sustainable or just a temporary surge.
Let's talk about risk disclosures. Any new concerns management is flagging?
The political and budgetary environment is front and center. Management details the government shutdown that lasted from October 1st to November 12th, 2025, and notes that Trump administration executive orders are directly related to significantly changing the current DW procurement policies and procedures. They explicitly state the potential impact of which such changes, if affected either by executive orders or changes to the relevant law, to the industry, and to Kratos, is unknown at this time.
That's significant uncertainty for a government contractor.
Exactly. They're also concerned about continued budget pressures and potential future shutdowns. Management believes these could have serious negative consequences for the security of our country and the defense industrial base, including the company. When a defense contractor is worried about the stability of defense spending, that's a structural risk that goes beyond normal cyclical concerns.
How does their liquidity position stack up against these risks?
From a liquidity standpoint, they're well positioned for the near term. That $560.6 million cash position against $296.7 million in long-term debt provides substantial flexibility. But here's the key consideration. They're making what they describe as significant capital, property, plant, equipment, and other internally funded investments across multiple facilities and programs.
Can you quantify those investments?
The filing lists extensive capital projects, a hypersonic system facility in Indiana, turbojet engine expansion in Michigan, a new turbofan facility in Oklahoma, expanded microwave electronics facilities in Israel, plus procurement of long lead items for 60 Oriole and 60 Zeus solid rocket motors. They don't provide dollar amounts, but the scope suggests hundreds of millions in capital deployment over the next 12-24 months.
That's a significant bet on future demand.
It's essentially betting the company on this generational recapitalization thesis. If defense spending holds up and their programs win, they're positioned for substantial growth. If budget cuts materialize or programs get delayed, they'll have significant stranded capacity costs hitting margins that are already under pressure.
Let's break down the segment performance. How are the two divisions performing?
The KGS segment drove most of the growth. Revenues increased $189.0 million versus $21.5 million for the US segment. Product sales, which tend to be higher margin, rose $164.9 million to $877.0 million, representing 65.2% of total revenue. That's actually a positive mix shift toward products versus services.
But margins still compressed in KGS?
Right, which tells us the cost inflation is overwhelming the favorable product mix. KGS margins dropped from 27.6% to 24.4% despite selling more products. That suggests either their fixed price contracts are underwater on current costs, or they're absorbing startup costs for new programs without corresponding revenue recognition yet.
What should traders and investors be monitoring going forward?
First, watch for any backlog disclosure in their quarterly filings. total backlog dollars, and book-to-bill ratios will tell us if this demand surge is sustainable. Second, monitor their working capital consumption quarterly. Management expects continued advanced purchasing, so if working capital burn accelerates beyond their cash generation, that changes the liquidity picture quickly.
Any specific guidance from management?
They're notably absent on specific financial guidance, which is unusual for a defense contractor with record backlog. They mention that investments related to their Prometheus venture and Bladeworks facility are expected to begin to ramp up during 2026, but no revenue or margin guidance. That suggests either limited visibility or concern about making commitments in this cost environment.
What would prove your mid-cycle expansion thesis wrong?
Two specific data points would contradict our thesis. First, if gross margins recover above 25% in the next 2 quarters while maintaining revenue growth, that would suggest they've successfully passed through cost inflation and were actually in early cycle expansion with more margin upside ahead. Second, if they announce backlog conversion rates above historical norms, say 40-50% of backlog converting to revenue within 12 months versus typical 25-30%, that would indicate we're in late cycle peak demand rather than mid-cycle expansion.
How should we frame the valuation here?
At current margins of 22.9%, this equity trades like a mature defense contractor managing cost pressures, not a high-growth technology disruptor. The market needs to see either margin recovery or sustained revenue acceleration to justify any premium valuation. The balance sheet provides downside protection, but the upside case depends entirely on execution of this massive capacity expansion while navigating unprecedented cost inflation.
Any final thoughts on the investment case?
Looking at the full weight of evidence, our mid-cycle expansion thesis holds. They have record demand, strong liquidity, and are investing aggressively for growth. But margin compression and cost volatility create significant execution risk. This is a leveraged bet on defense, spending stability, and management's ability to navigate supply chain and labor challenges while scaling production. The next 2 quarters will be critical for determining whether they can stabilize margins while growing revenue.
That's our analysis of Kratos Defense and Security's fiscal 2025 10K filing. Remember, this discussion is for informational purposes only and should not be considered investment advice. I'm Sarah with Mike. Thanks for listening to Aviation Intelligence Weekly.